the people that trusted institutional investors and have put you in this garbage. Because, hey, baby, it's risk on again, isn't it? And they're doing this just as junk loan defaults surge as higher interest rates start to bite. Duh. I mean, this is not rocket science. This is actually pretty darn simple. If you borrowed money at 0% interest, and now all of a sudden you have to pay 5% interest or 7% interest, those payments are a whole lot higher. If your income didn't keep pace with the rise in how much that was, you got a problem. And default rates are ticking up. Are they going to keep going higher? Well, what's the Fed say? They say, now we're going to see if this is true or not, but they say they're going to raise rates 2 more times this year, 1/4 point each. It's not going to do crap. We are entering the phase of hyperinflation. We've got to have a huge crisis because they have to shift us into their next iteration of money and control, the CBDCs. Don't go there. I vote with my purse. This is my vote. There is a payment shock unfolding among the weakest issuers in the loan market. And of course, it always starts with the weakest. So you've got to pay attention because they're the canary in the coal mine. Bank analysts and rating agencies expect defaults to rise further as market expectations shift to interest rates staying higher for longer and as the lagging effects of successive rate rises are felt. Because it takes 12 to 18 months from Fed policy till it works through the economy and they see the results. So we are only now seeing the impact of the rate rises that they did 18 months ago, 15 months ago. We have not seen the full effect yet. Of course, once we go to CBDCs, as they say, they can have their finger on the button constantly. 24/7. You're not spending enough money because, hey, we're a consumer-driven economy. All right, let's drop those interest rates lower and eat your principal more. Noticeably, when you see that, what do? You go out and you'll put your money in anything that you think can hold its value the best. But what's proven to hold its value the best? Right here, baby. That's what is proven to hold it the best. And silver will maintain it. But gold actually does hold it the absolute best. This total in defaults exceeds both 21 and 22 combined. Well, it's going to because we have the free we had the free money, right? And that ended basically sometime in 22. But for this total to exceed it, you got to know, pattern shift. Take heed. You don't have to understand necessarily what it all means, but you know that when you see a pattern shift, it means something. This is not good. This is not good at all. Powell wake-up call means more corporate defaults, and that's from Credit Weekly. Oh my goodness. The maturity wall is starting to rise as quantitative easing fades. Quantitative easing did not work. Admittedly, central banks all over the place are coming out and saying quantitative easing, all this free money, I wish they could run out of it, did not work. And now he's getting a wake-up call because corporations are defaulting. Shocker. But what was encouraged with all of that was to go to shorter and shorter term rates. It's kind of like what's happening in the mortgage markets here in the US, where most mortgages are 30-year fixed. You have some variable rate, you have some shorter term, but most of them are 30 years. So with rising rates, the people that are sitting on those cheap mortgages, they're not likely to sell them. In Europe, on the other hand, they're only fixed for typically a certain period of time. People don't have 30-year fixed mortgages. So as interest rates go up, well, they're going to have to pay that higher rate. And the same thing, when they put in quantitative easing, it was to encourage corporations to take their longer-term debt, roll it into shorter-term debt at really low, at zero interest rates. And so they did that. And you can see high-yield debt has shortest maturities on record. And all that debt, this maturity wall, is coming due now and has to roll over. If these monetary conditions continue for as long as the Fed says, we're going to see a lot of mortality in the corporate sector, and this process is only just starting. Zombie corporations are about to become very, very obvious. Very, very obvious. And what will this do to the stock and bond markets? Makes them even more vulnerable, even more sketchy.